Welcome, everybody. This is Chris Craddock. I am excited to be here with you today, being able to talk about the state of the market, what is going on with us here. So with that said, I mean, so many people I've just seen so much fear going on, and we just don't need to live our lives in fear, right? We need to ask ourselves, what is actually happening in the real estate market as we're looking at it right now. So we're going to go over the state of the market. We're going to ask some questions. What is the best option for us moving forward? Where should we put our money? Bottom line is all of us are betting somewhere, right? Whether you own a house, whether you're renting, whether you own rental properties, regardless, those are all bets. And we're going to talk through that. And we're going to say, where is the best place, the safest place to put our money, energy, and frankly, investment. So that's what we're at. So right here, I keep seeing this graphic go across the internet, right? Where you see the Grim Reaper, he just slaughtered stocks. He slaughtered crypto. And now he's knocking on the door of real estate. And honestly, I think if we don't address this elephant in the room, we are we're not in a good place. So with that said, today we're going to look at this, like, is the Grim Reaper knocking on the door of real estate? And should we be afraid? So the national news, essentially their goal, just so we know, if you're reading the news, you've got to understand that the goal of the news is to freak people out. Because when you're freaked out, like, I don't normally read the news, but when this whole thing with Russia happened, I started reading the news like crazy. And then my anxiety started going up, like it just went up and up and up, because the news is out there to make our lives scary, right? Like that's what they want to do. They want to, because I was like, oh my gosh, are we entering World War III? Is this happening here? And if that's the case, then we've got to ask ourselves, like, what's going on? Bottom line is, I started getting fearful because I started reading the news, and then I read the news and I got more fearful. And then when I just was like, listen, what's going to happen is going to happen. And, there's always going to be wars and rumors of wars, and stop doing that. Then it stopped taking over my brain space. And it allowed me to get back to doing what I do, becoming the person that I want to be, investing in the places I want to invest, get the fear out of my life. So with that said, we need to ask ourselves, one, what's going to happen with the mortgage rates, right? I mean, heck, nobody talks about this, that the mortgage rates actually dropped a little bit. The interest rates actually dropped a little bit over the last week. So it doesn't mean that it's only going up. It doesn't mean that they're dropping in general. They're probably going to continue to go up, but the reality is it's not always doom and gloom. And that's the only thing the news pitches. So one of my buddies talks about this, Tina, right? So Tina there is no alternative. We ask ourselves, where can we put our money? So let's think about it. We have money to invest, right? One, we could put our money in stock market. Well, the stock market is not going up anytime soon. It is definitely continuing to go down. We are entering a full-blown recession, and I don't think that any of the stuff that's going on with our government is going to make it any better anytime soon. We are entering a full-blown recession. The other thing is, we are headed for massive inflation. We already see a massive inflation with everything. So the stock market is hurting, and it's going to continue to hurt. If you have your money in cryptocurrency, you are probably crying yourself to sleep at night because you've lost 2/3 of your net worth if that's where you keep your money in crypto. I don't know about crypto going forward. It may be great. It may be terrible. It may go to zero. Some of the coins have gone to zero. But the bottom line is, regardless, like, cryptocurrency is one of the most volatile asset classes you could put your money in right now. It may be great down the road, but right now it's still massively volatile. And it's just not a place where I want to put any money that I care about. Maybe, I'm probably going to put a little bit of money in there, like as a flyer, like, hey, if this goes up, it's really good. But I'm not going to put money that if it goes away, I'm going to cry myself asleep at night, because, that's just important. So gold and silver, we're even seeing commodities. The values are going down with commodities right now. So the only place left that has not been slaughtered, like that Grim Reaper knocking on the door, the reason they're saying that is because it's the only place that hasn't been slaughtered is real estate. And so we need to ask ourselves, is the real estate slaughter coming, or is this the only good option? Tina, there is no alternative. Well, I don't want to let the cat out of the bag. I think you probably know, because of what I'm all about, what my thoughts are on this. But let's jump into what that looks like right now. Oh, well, the last option, don't let me forget this one. You could choose to rent a property. You could choose to not buy assets and put your money in the bank, but you're still making a bet when you put your money in the bank. When you put your money in the bank, you are betting, you're betting that 1% interest that you make from the bank is going to be better than that. Well, the government claims it's 8.1% inflation. You look at, everybody that's not tied to the government is saying that we're like a 15% inflation. And let's just be honest, the dollar store is the $1.25 store, right? We know that inflation has taken over. Gas, like everything is more expensive right now because the government has just printed more dollars. So with that said, we need to ask ourselves, what is the best option going forward? Well, with real estate, it's also an interesting thing, because real estate holds its value a little bit more because of the fact that it's an asset class. And we're going to look at 2008 and some of these massive crashes that have happened over the centuries, and why we've seen these crashes and what has caused them. But we're also going to ask ourselves, what is a solid investment and why? Real estate as an asset class, it's so interesting because you can renegotiate your deal. Your asset class it's just a different asset, right? One, you can't live in your stocks. You can't live in your Bitcoins. You can't live in well, I guess you could live in your gold. That'd be a pretty cool, cool place. I guess King Solomon probably did a little bit, but you can't live in that stuff. So as an asset class, you can refinance your property, right? Boom, that's pretty sweet. You can make updates. You can make your, you have no ability to make your stock more valuable. There's probably ways that you can do it, but you can't go in and update a kitchen, update a bathroom and make it a more valuable asset, right? You can't put an addition on the stock. You just don't have that kind of control on it. You can't convert from a short-term rental from a long-term rental or a property you live in to a short-term rental, like an Airbnb or a VRBO. Heck, if I want to make more, all of a sudden I'm in trouble and financial trouble and I own my house, I literally can put ads in the newspaper saying, hey, rent my basement, rent one of my rooms, and create extra income from my real estate. And then the last piece that I think is just really, really interesting is you can pay no taxes when you sell a property. If it's a personal residence and you live there 2 out of the last 5 years, and you're single, you can make $250,000 and not pay any taxes. If you're married, you can make $500 and not pay any taxes. And if you have it as an investment property, you can put it into another investment property and do something called a 1031 exchange. And that 1031 will allow you to pay no taxes on that. So we're here in the DC area, and I just came across this. This is so amazing. Petworth, a place where you're buying row homes for somewhere between, I don't know, you see the lower priced ones that are not like total dumpster fires. Usually they're like high sixes in the sevens, 700,000s. We see this one, what the price was, it says 8,950. So not the thousands, the hundreds, thousands, but you also see them up to like 1.2, $1.4 million, right? These houses were originally sold for, right here, here's an ad for Petworth, $8,950, only $500 down. So when we look at the history of real estate, we realize that real estate is like, nobody's grandfather is like, man, I'm glad I sold that house 40 years ago. It doesn't work like that. It just does not work like that. On top of that, what I'd love to share is this: the house I live in now, right? I've been here. We bought it in 2006. We bought it at the highest point you could buy in, right before the biggest crash in the history of all crashes other than the Great Depression. I'm going to share real numbers, right? This is my house I live in right now. we are actually building a new place. But the cool thing is, I bought this, for 690,000. I'm just going to tell the real numbers in 06, 690. The market crashed, biggest crash we've ever seen, right? I lost over 6 figures in equity. Well, here's the crazy thing. I was still living here, so I just kept paying for it. And then the interest rates went down and I was able to refinance the house and bring down my payment. The cool thing was I was able to bring down my payment. Then the rates went down again and I was able to refinance and go to a 15-year note for the same price I was paying for a 30-year because the rates just kept coming down, right? They say date your rate and marry the house. And so my rate, I traded in for another one, and I got to a 15-year note. I'll tell you, the crazy thing is, this house will almost be paid off. In 2 years, it'll be paid off. I'm going to keep it as a rental when we move into when our house is done, when the construction is done. And here's the nutty thing. This house that I bought at 690 at the highest part of the market, the house across the street from us just sold for $1,025,000. Right? So I bought it the worst time you could possibly buy. The reality is, and please get this, it's not timing the market, it's time in the market. The difference between the geniuses and the idiots are how long you hold your real estate. So the crazy thing is, when you look at what housing prices cost back in the day, like, we realize that the prices are, it's just absurd how much things have gone up. So 1970, average home price, $22,900. 1980, average home price, $63,333. 1990, $94,500. 2000. All right, so we started at 22, 2000, 147, 433. Now, this is where I want everybody to listen and understand. We had the biggest crash in the history of all crashes. And during that decade, minus the Great Depression, all right, just give me a little grace there. During that decade, 147, 433 in 2000, and 2010, it's at 170, 567 as your average home price in America. The prices went up in the midst of the biggest crash in the history of all crashes. Do we understand this? Do we get this? The real estate is a great investment over the long term. 2020, so it goes 2010, 2020, 309, 2021, 358 as the average number. So the next question that we have to ask ourselves, what causes prices to go up and down? Well, prices is a function of supply and demand, right? Think about it. If we have a room full of people and we're all thirsty, we can go in the other room, turn on the water, and it's so inexpensive to turn on the tap and get water out of it, right? Well, what happens when you go to a ballpark, right? That bottle of water is $8. Why is it? Because it's less available. Now, if the ballpark would allow Grubhub to come in, you could buy it and, pay a little markup for it. If you could buy it, if it's freely available, then you can get that. A beer is like what, $15 at a stadium now. So it's not that if you just go to the store, if it's readily available, but that's it. If you constrict the supply and demand stays the same, then the prices go up. So that's what has happened going forward. Well, the question we have to ask about the real estate market is there more supply, or when the market goes where it has been, when interest rates go up, is there going to be less demand for properties, which will then drive the prices down? Because that's the only way prices go down, is if there's less demand or way more houses. Builders build so many houses that people can't get into it. Well, millennials, there are 80 million millennials right now. And of them, 70% of those millennials say that they plan to buy a home in the next 3 years. Do you realize what happens? Like, literally, if you look at any other developed country in the whole world, there's nobody else that has a generation that is moving into home buying age. Like, literally, this is one of the jokes that I used to always tell. Millennials used to say, we're going to rent. We're not going to buy. We're just renters. And, I heard this comedian, he was just like, look at these millennials walking around like they rent the place. It's just ridiculous because, millennials moved from saying, hey, we're transient to, hey, we're putting down our roots. And now that they're putting down their roots, there's way more demand coming. And like, this is a massive shift from 80 million people that had chosen that they don't, as a whole, that they weren't going to be buying houses to, yes, we are now purchasers. We're now buying. 40% of all mortgage applications are with millennials right now. So we're seeing that alone will push a 6 to 9% increase in the market, barring anything else. So we see, millennials, we got baby boomers. Here's the other piece. So many people have really cheap mortgages. If inflation is at 15%, let's just call it 8%, and somebody's mortgage rate is at, let's call it 3%, by holding on to that mortgage, that previous house, and keeping it as a rental, you are destroying your debt. It's going away, right? Because your dollars are inflated way faster than your interest rate. So it's going away. And my friend Jason Hartman talks about this. You should definitely check out his stuff. It's really, really powerful. A lot of the stuff I talk about here is if originality is forgetting who you stole it from. He's one of the people that I follow regularly as far as his market data and analysis. And it really is powerful to see what's going on as far as our supply and demand. Builders, we're off by 5 million homes. Because between 08 and 18, builders built so much slower because a lot of them went bankrupt. Banks were less likely to lend. Builders were more afraid. So even though the economics of it made sense, they were still slow to build because a lot of them got burned when our government was allowing, mortgages to get made to McDonald's workers that were making minimum wage and qualifying for, $1.5 million houses. It just didn't work then. But now builders are trying to catch up. So if price is a function of supply and demand, we already know that millennials are coming, 80 million people are coming into the home buying world. Well, what about the supply, right? We already are way, way, way short. Actually, here's the number. As of March of this year, we were at 344,000 homes available, right? 344,000 homes were available for sale. And in a normal market, so like, let's go back to 2015. In a normal market, you're looking at about 1.2 to 1.5 million houses. That's a neutral market. So any more than that available, you're looking at a seller's market. Any less, you're looking at a buyer's market. Any less than that available, you've got a shortage in supply. So there's more buyers than there is inventory, and that pushes the price up. Now, when there's more inventory than buyers, it pushes the price down. So that's the key right there, is we're seeing that there's not enough inventory. Builders didn't build enough. People that are moving are holding on to their old mortgages because their old houses, because the mortgage is cheap. Frankly, real estate as an asset class is huge. One of the other things that we're seeing is people have more discretionary funds. I mean, this is another thing that happened in 08 is people didn't have any money available to them. Like they ran out of money quick because they were buying way more than they should. Right now, the average American has more discretionary income than any other time other than during the middle of the 80s, right? During the Reagan boom, that was the only time in the last, I think, 60 years that people had more money available, discretionary income available to them. So with that said, what happens when rates go up, right? So rates are going up, and we're saying these rates are absolutely, a lot of people are saying, oh, they're not sustainable. They're not sustainable. But I'll tell you, when I bought my property, my first townhouse in the early 2000s, I bought with an 8% interest rate. 8%. And when and I still remember buying, and I was like, oh man, that's a high rate. And all my buddies, like older friends, were like, oh, when I was your age, Sonny, like when I bought, I was buying at 18%. I was buying at, all of these different rates. And so So looking at that right now, the current rate, I think it's actually a little higher than this because this was taken from about a week and a half ago, and I think the rates have gone up just a little bit. But current rates, according to this, is actually no. Here it is, and on here it said current rate 5.09%, but now it's actually 6.125%. So that's where we are. We're still at a great rate relative to historic trends and historic data. And here's the other thing. A lot of people are saying, I am not going to buy a property. I'm going to rent instead because the rates are too high. Well, if that is the case, what I just want to say to you is, do you know what the interest rates are on a rental? What are the interest rates on a rental? It's 100%. That is it, like 100% on rentals. Like you are literally buying somebody else's house for them. You get no equity, nothing at it. I want to tell a story. A few years ago, we were buying I was walking into a house as a real estate agent, and somebody had asked me to come over and take a look at the house. They didn't tell us that we were looking at a property with a renter in there, that they didn't tell the renter. They told the renter we were a contractor, right? So that was one of the things that as we were looking at it, we're going through, and I'm just talking about the resale, and all of a sudden the tenant was like, wait, you're selling this house? And we're like, what? They're like, but I've been here 24 years. Like, how that doesn't work. Like I literally paid this house off for you. And the owners were like, yeah, thank you. Like that was the deal. So what we've got to understand is if somebody decides to rent, like literally, if you rent, you're paying off somebody's house. It's either your house or somebody else's house. Let's say like I have a couple friends. You say, hey, I want to rent for 3 years. Well, 3 years, average rent price here in this area, let's just call it, it's actually a little higher than this, but let's call it $2,500 a month. At $2,500 a month, you're looking at $30,000 a year, right? 3 years, you're paying $90,000, right? Now some of it goes to paying interest and everything else, but that $90,000 would be money that you'd be paying off your house for. Plus, with that, by owning a house, you'd probably save you're looking at another $400 to $600 a month in taxes that you save by owning your own house. It's just a no-brainer. Even if you buy at a high point in the market, you pay off your house so fast by owning it. And frankly, the other bet is like, is the market going down? Maybe it'll go down a little bit, but the reality is eventually it's always going up. And trying to time the market is just, it's time in the market. Buy, hold that property, and then buy another one, and then buy another one. And then life is monopoly, right? You win when you buy real estate. So with that said, we've got to understand that the rates are so low if you look at the historic data. The next thing that we got to ask ourselves is do recessions come? Does housing inventory grow when recessions come? They can, but the question we have to ask ourselves is, why do they come? So a lot of times, like if you look at 2008, what happened was people didn't have the money to afford their house and they had no equity in their house. So because they were buying at the top. So the average American has 43% equity in their house. So if they own a house that's worth, let's say $100,000, they basically owe $57,000 on it. So it's 40. Now, if the average home price is almost $400,000 and it's 43%, you're looking at, what is that? You're looking at almost $170,000 worth of equity, right? So let's say the market did go down a little bit. Is that going to create a huge housing crisis like it did in 2008? Because it went down a little bit and then people couldn't afford it because frankly, everybody was getting loans that they could not afford. And then what happened was the whole house just blew up. Like the whole house of cards blew up because nobody could afford anything. And then when it went down, people started selling and then it went down a little more and then they couldn't afford it. But here's the crazy thing. We have more equity in our houses now than just about any other time. Literally 40% of all houses in America, homes that people live in, are paid off, which is crazy. People have more discretionary funds than any other time other than the 80s Reagan era boom. There's no other time that people had that. So if that's the case, even when a recession happens and people lose money in the stock market, they have money in their houses. They have money that, available to them. So we're not looking like we're going to fall off a cliff, because the other thing is people are not getting loans that shouldn't get loans, right? I look at when we bought our lake house last year. I literally, so my just to be transparent here, my finances are massively complicated. Massively. I think I've got something like 27 different LLCs or S corps or just entities, right? They are just massively complicated. Well, with that being the case, what the deal is like I sent it through a normal lender, and the normal lender didn't say I'm disqualified or not approved. They just were. It was just taking so long because they had to verify all these different entities and just go through it. And it was a nightmare. I almost lost the deal. Now, here's the crazy thing. They didn't rubber stamp it and say, yep, you're good. But here's the thing. This is what's so crazy. Because it just kept getting pushed and pushed, I almost lost the deal. I literally had the cash in the bank to be able to buy that house in cash. I bought that lake house in cash. I refinanced it with a commercial loan. Interest rates a little higher with the commercial loan. But the reality is, on the one hand, I was super annoyed, just real talk, super annoyed. But on the other side of it, I was actually kind of proud of our country that like we have, we're not just giving everybody loans, even people that like my debt to income ratio is ridiculously low. Like I'm in the 20s, right? And I think you need to be like a minimum of like 42, 43%. And I'm like, it's way low. Like I should if you use common sense, it's a rubber stamp, right? To buy what I need to buy. But I didn't fit all the criteria, and they're holding strong with how they give loans in this era. So it is a really, really, really important thing for us to look at there. So with that said, one of the things that I think is really important to look at, Dave Ramsey, some people love him, some people hate him, but I want to just share what Dave Ramsey has to say about this, the future of real estate. So,
all right, let's talk real estate. A lot of folks are saying, I'm going to sit on the sidelines and wait on buying because house prices are going to go down. Let me help you with this. House prices are caused by one thing and one thing only: supply versus demand. How many houses are for sale versus how many buyers there are. Buyers are fewer in a bad economy, a high interest rate economy. There's fewer buyers, but they have to be less buyers than supply for house prices to go down. That's not going to happen. Here's the real numbers. Here's data, not feelings. Let's talk this through. 5 million more 35-year-olds right now in the millennial generation, prime house buying age, than there were in 2007. 128 million households right now. In 2007, only 116 million households. 12 million more households operating that need a house. And yet there's a shortage of housing. In 2007, we had 2.1 million new housing starts. This year, we'll have 1.4 million new housing starts. We have 50% as many houses for sale right now as we had in 2007. Inventory is at half. So the number of buyers would have to go down so dramatically before the house market prices go down. It's not going to happen, guys. House prices went up 32% in 2020, 18% in 2021, 7% this year in 2022. Next year, projected to be a 5% increase. Every year for the next 5 years, we're going to have fewer houses for sale than buyers wanting to buy them, driving the price up. House prices are going to go up every year for the next 5 years. If you're ready to buy, you're in good shape financially, you need to buy now. Don't wait on house prices to go down. They're not going down. What goes up must go down. No, it doesn't. I just gave you data, real facts. They're not coming down.
All right. So we're going to finish up just asking the question, what do we do next, right? Is the housing market going to crash? Supply, there's not enough supply. There's not a world in which there's enough supply. We are so far below where we need to be. There's just not much supply. And frankly, even if people start losing jobs, equity, like people can sell their house with a lot of equity in their property. So we're not going to see a massive exodus, people selling their houses. They've got too much equity. They've got too much cash on hand. Things would have to be really bad for a really long time before we're going to see a massive drop. One. Number two, demand. There's too many people entering the housing market for us to have a massive problem there, right? We've got 80 million millennials entering the housing market, which all of them had previously said, not all of them, there were some that didn't want to do this, but the majority of millennials had said they were renting in the past. And now we're at a place where they're ready to buy. They're ready to stop being transient and settle down. So they're going to be buying. So there is a massive demand. There's very little supply. And that's what we're looking at. So what should we do going forward? I'll tell you, here's what I think is going to happen. We may see a slight decrease in prices, lots of enter into a slightly normal market, not exactly normal, but slightly normal. And what is going to happen there is people, you're going to be able to get seller subsidies again, loans like first time home buyer grants are going to be accepted again. Inspections are back. It's just going to be a little bit more normal than it was, right? I still remember when I started in real estate, the average days on market was 46 days. And over the last year, I think the average days on market has been something like 8 or 9 days, right? So it's just been massively extreme. And I think we're going back to normalcy. And even with the craziness in our economy, a recession, because of the fact we don't have enough houses, this is the one asset class that is going to be protected. Plus, the value, the utility of real estate. There's just a lot of other pieces to it. People can buy it, rent out rooms, all the other things to make it more valuable to them. How many people own lake houses that they never use, right? All of a sudden they start Airbnb-ing them or short-term rental or other things like that. You're just going to see people start using more utility of that if the rest of the market goes down. But the fact that there's not enough houses for people to live in, that's the big problem there. So with that said, if you have any questions, if you want to dig deeper, let us know. I do think that at this point, there's ways to get into houses that are a great purchase. In the past, it was hard, right? But even if you're buying at the top of the market, just hold on to the house and you're going to pay it off. You're going to be able to live there, the utility, everything else is there. So bottom line is nobody has a crystal ball. If we did, we'd all be sitting on a beach in Tahiti right now. But the fact is we don't. But what I can tell you is from personal experience, as somebody that bought at the very, very top of the market, and now I'm going to have within 2 years, $1 million asset that's completely paid off. This real estate, it just doesn't get any better than this. It just doesn't. So with that said, if anybody, the people that invited you, if you want to just reach out, talk about investing, anything like that, just reach out to people that invited you, click, comment below on this. If you're seeing this on social media, reach out to me, social media at Craddock is my Insta, or Chris Craddock Official on TikTok. Just reach out to me. I'd be happy to talk more in depth about any of this stuff. But bottom line is, if you want to build your wealth, if you want to grow, you got to be in real estate. The difference, last thing I'm going to say, I promise, I'm not going to say any more after this. The difference between the average net worth of somebody that rents versus somebody that owns is 48 times, not 48%. It's not like if you have $1, you have $1.48 if you're somebody that owns real estate. The difference is if you have $1 and you're a renter, and you own real estate, you would have a net worth of $48, right? It's so massive. So there's not even a question. The people that rent properties don't build their own net worth. They just don't. They're building somebody else's net worth. And there's nothing like buying a rental portfolio, holding onto it. And here's the deal. Let's say you have no money to buy it. Well, now you can use first-time homebuyer grants. Almost every state has a first-time homebuyer grant now. These first-time homebuyer grants, let me just tell you about a buddy of mine. He bought a house, got the closing costs covered by the seller, had a first-time homebuyer grant. It cost him, what was left over in down payment was $2,000. This was for a $350,000 townhouse. $2,000. He had 3 rooms upstairs. He rented out 2 of them. He slept in a smaller room. And then he had in the basement, it wasn't really a bedroom. I called it the dungeon. It was this small little room with no window, no door, like one door. Sorry, it did have a door. But he was able to rent that out for $500 a month. He lived there, and he either made or it cost him $200 a month. I think he made $200 a month. I just can't remember the exact details on that. But regardless, even if it cost him $200 a month to have other people pay off their house, it's just powerful. So with that said, reach out to us if we can help you, if we can serve you. And until then, go live uncommon. See ya.